Hello, my name is Liz Schlemer, and this is IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. This particular video is about depreciation with an accelerated method, and the method that we'll be using is MACRS. So the topics covered in this class are these 5 topics, and this particular video falls under investment analysis and a little bit on reporting and managing profits. So MACRS depreciation is a depreciation that is stands for Modified Accelerated Cost Recovery System, and it's an IRS type of depreciation. So anybody who pays taxes follows this depreciation method, and that's why this is the method that you need to know as an engineer, because this is the method that you'll be using when you do calculations for cash flow. And there's a couple special things about this. It always assumes that there's 0 salvage value, so you never have to include salvage value. Even if it tells you in a problem that there's $5,000 salvage value, for calculation of depreciation, you use 0. It also assumes that all assets are purchased on July 1st, which implies this concept of a half-year convention. So the first year of depreciation is only half of the accelerated method. The next years are the full calculation of depreciation, and the last year is another half year. So you'll see how that works out when you look at the schedule that is given. It's not, you don't have to do anything to adjust for this unless you sell the asset early. But if you just apply the depreciation system, it's based on a half-year convention. But it's just a way of explaining the way the depreciation method looks. It also has a recovery period defined by asset type. So what we do is we have this table that the IRS provides. This is a abbreviated look at this table, but it says what particular property type there is, and then what's the recovery period. So if it's a computer, it's going to be a 3-year recovery period. If it's an automobile, it's going to be 5-year. So what you do with that particular recovery period is you go to this tax table, which shows you each of the recovery periods as columns 3, 5, 7, 10, which is the same as this one, and you look up the rate at which it's a percentage at which you recover the asset. And if you add up all the numbers in each of the column, they all equal to 100%. So it's saying that you're going to recover 100% of the asset value over that life period. Now, remember when I told you that there's going to be a half-year convention? So if you look at the 3-year recovery period, it says that this 3-year recovery period, it says that you have 4 years of depreciation, which is a little bit odd because it's a 3-year recovery period. Why is there 4 years? And that's because of the half-year convention. There's actually only a half of a year there, 2 full years, and then a half year there, which makes 3 years. So the way you just do this calculation is super easy. You just look up the MACRS percent and you multiply it by the initial value. So the depreciation each year is just equal to the percentage times the investment amount. And most of the time you'll just be given a particular recovery period and you'll just look up the percentage in this table. There's also a PDF of this table in PolyLearn, so you can print that off. It's also available online everywhere. So let's just do an example. What's the depreciation in each of the 3 years of a life of a widget tester that costs $13,000 and has a salvage value of $4,000? Use MACRS with 3-year recovery. Now remember, it doesn't matter what the salvage value is. So all we're going to be doing is just take that percentage. So in this case, it's a 3 year. So we're going to use this column, and the first year is 33.3%. So I put that value in there and multiply it by the I value. I ignore the salvage, and I get depreciation of $43.29. Second year, I take the next amount here, which is $44.5, get the depreciation in that period, and I just go through, and I have 4 years of depreciation. Remember, even though I said it was a 3-year recovery period and 3-year life, we have 4 years of depreciation. So if we go ahead and put that into the cash flow calculations, we have depreciation laid out there. So both we take it out for tax purposes, and then we also add it back for cash flow purposes. In accounting, most of the time I use a parentheses around numbers to indicate a minus. I put minus here, but this is also the more standard accounting method of doing minus numbers. So one thing you just got to notice, again, I have an extra year depreciation because of half year convention, so I just included that as a write-off in that year. It's also okay to have negative taxes. Now, it's never that the IRS will give you money back that you never paid. They will never kind of give you money. But if you're part of a larger company, these negative taxes will be able to shield income in other areas. In addition, you can do loss carry forward or loss carry back. So if your whole company is losing money, you can take that loss and put it to a different year to offset your tax liabilities in those years. But again, the IRS will never give you money. They will only lower your tax burden. So we look at this is a cash flow. You can see it's quite accelerated. The cash flow is much higher in the first years than it is in the last years, but that's how accelerated cost recovery system works. This particular video covered investment analysis,